Chapter 16 is on reporting the statement of cash flows. And this is one of the more difficult financial statements to not only analyze, but to prepare. In this chapter, we're going to look at the three sections that the statement of cash flows is divided into, which is operating, investing, and financing. We are going to apply the cash flow statement to the total assets ratio, actually prepare a cash flow statement, and then the method that we will use for this is the indirect method. You have two methods, the direct and the indirect. We're only going to be working with the indirect method. Okay, so the purpose of the cash flow statement is to look at where the company is receiving its cash from. And it's looking at why income would differ from one reporting period to another. And it also explains the change in the cash balance. On the balance sheet, it's going to show what is in cash, what was in cash at the end of last year, and what was in cash at the end of this year. And you'll see the difference between the two, and the cash flow statement explains that difference. And it also is going to look at exactly where the company is spending its money. The cash flow statement also helps users decide if the company has cash to pay its debts and to help them prepare for any unexpected opportunities. The managers can perform their day-to-day operating activities, and they can also look at any long-term investment decisions just by looking at the cash flow statement. Okay, one of the things that we're going to look at first is what cash equivalents are. We've already looked at this before in other chapters. Cash equivalents is just anything that's highly liquid. Cash is the most liquid because it is cash. Liquidity is the amount, how close to cash is it. So anything that can be readily convertible into cash is considered cash equivalents. Okay, again, the three sections of the cash flow statements is operating, investing, and financing. So looking at operating activities, some of the cash inflows, which is money coming into the company, is going to come from cash sales from customers, credit sales from customers. If the company receives a dividend from an investment, or if the company receives interest from a loan that someone has. The outflows from operating activities would be the usual of paying taxes, paying salaries, paying suppliers for the goods and services they purchased, and also paying operating expenses. Those are all cash outflows or money going out of the company. The second section is investing, and different activities that would be an inflow from investing is when you sell a plant asset, you sell intangible assets, you sell long-term investments or short-term, and then selling any notes receivable. Also, if you collect on a note receivable, that is also a cash inflow for investing activities. Some of the cash outflows would be if you buy plant assets. If you buy a plant asset, money's going out the door. You're exchanging it for another asset, which is the actual piece of equipment or machinery. If you buy long-term or short-term investments, or you loan money and give them a note receivable, that's also a cash outflow for investing. Financing activities, cash inflow would be if you issued common or preferred stock, if you issued a bond, if you reissued treasury stock, or if you have a contribution from the owner. Treasury stock is when the company buys their own stock back. They go out on the stock market and they purchase their own stock. That is considered treasury stock. The cash outflows that would go along with financing activities is they pay their shareholders dividends. they purchase treasury stock, the owners withdraw money, or they pay any of their bonds or notes payable. On a cash flow statement, you will also list any non-cash investing and financing activities. Some of these could be you convert preferred stock to common stock. That's making a change in an investing or financing activity, but it does not include cash. If you retire a debt by issuing equity instead, that is also investing or financing activities. So these are just some that are non-cash, even though it may increase an asset. It's like a barter. They're exchanging something for something else, and it's not cash. Okay, let's go ahead and prepare a statement of cash flows. This is the general format for it. It will have the same 3-row heading: who, what, when, who's the name of the company, what is statement of cash flows, and then when is the period that it's covering, which is usually a month, same as an income statement. You'll start with the operating activities first, and you'll list you'll list this individually, the inflows or outflows. And then you'll get a subtotal, which is either net cash provided or net cash used by operating activities. If your inflows are more than your outflows, you will have net cash provided. If your inflows are less than outflows, that means you spent more money than what came in. That is considered net cash used by operating activities. In the investing section, you'll list individually any of the inflows and the outflows. And again, if the inflows are more, you will have net cash provided. If the outflows are more, you will have net cash used. Then we go on to the third one, which is the financing activities. And again, you'll list them individually, inflows and outflows. If your inflows are more from financing, then you have net cash provided by financing activities. If your inflows are less, you will have net cash used by financing activities. Then you'll take the 3 totals of each of these sections, and that will tell you what your increase or decrease in cash is, and that should match what the financial statement says. You will take the balance from the prior period and subtract that, and you should end up with the balance of the previous period. And this is called proving cash. So the first thing that you do is you compute the net increase or decrease in cash. Then you compute the net cash from operating activities, then from investing activities, then from financing activities. Then you'll prove it by adding it to the beginning cash to get the ending cash. And your beginning cash will be your ending cash from the previous period. When you work on the cash flow statement, you're going to look at the income statement, the balance sheet, and even the cash account. This is a great place to go to look at what the inflows and outflows of cash are. So as you can see here, they started off with $12,000 on December 31st, 2018. And then they ended on December 31st, 2019 with $17,000. So we already know that there's a cash inflow increase of $5,000. We just have to show what that $5,000 consists of. So on the debit side of this T, you see you have receipts from customers for $570,000, receipts from the sale of assets is $2,000, and then receipts from stock issuance is $15,000. Now, those all don't go under operating because we have the 3 sections. We have the operating, the investing, and the financing. So these are going to go into different sections of the cash flow statement. Okay, then on the credit side, these are all the outflows that happen to cash for the month. We have payments for inventory, payments for operating expenses, payments for interest, payments for taxes, payments for notes retired, and then also payments for dividends. Okay, like I said at the beginning of this, there are two methods. There's the direct method and there's the indirect method. We are going to concentrate on the indirect method, which is what is in accordance with GAAP and for taxes. So this is a section of the operating activities. You'll see the operating activities right here. This is the largest section of the of the cash flow statement. And I'm going to go through these briefly and then it will go into detail in future slides. Okay, you're going to start with your net income. Your net income is $38,000. Your net income doesn't represent what you have in cash, but we're going to start with our net income and end up with what we have in cash. Okay, so the adjustments to reconcile net income to net cash is going to start with increase in accounts receivable, and that's $20,000. Okay, I'm going to go back a slide. No, okay. So you'll see, we will have a picture of the financial statement, and you'll see what I mean by this increase or this decrease. So what this is saying is it's saying that from the first day of the reporting period to the last day of the reporting period, accounts receivable has decreased. Oh, actually, accounts receivable has increased. Merchandise inventory is increased. Prepaid expenses has increased $2,000. Accounts payable has decreased $5,000. And interest payable has decreased $1,000, and then so on. So this is just a list of all of the activities that have to do with operating and cash. And we end up with net cash provided by operating activities for $20,000. And that is an increase. But that's not what we have in cash. You know that we have $17,000 in cash. This is just a section from the operating activities. We still have the investing and financing to go through. Okay, now let's look at the operating activities more closely. Okay, here's a set of financial statements. We have the income statement and we have the balance sheet. And then we also have some additional information provided in the bottom left hand of the screen. So let's start with the balance sheet. I want to look at cash. Just from looking at the T counts a few slides prior, we saw that we started off the year with $12,000 and we ended with $17,000. And that gives us a $5,000 increase from the beginning of the year to the end of the year. And accounts receivable was something I talked about as well. It had a $20,000 increase. In 2018, or actually the first day of 2019 as well, accounts receivable for this company was $40,000. It ended the year with $60,000. So they increased what is owed to them by $20,000. Same thing with inventory. They started off the year with $70,000 and they ended the year with $84,000. That is a $14,000 increase. Okay, let's skip a little bit and go down to long-term assets. In 2018, we started with $210,000. We ended with $250,000. So that's a $40,000 increase in plant assets. At this point, we don't know what that $40,000 increase is, and we don't know whether it's good or whether it's bad. All we know is that plant assets increased $40,000. And then also what we know is accumulated depreciation increased $12,000. So out of the plant assets, there was depreciation for $12,000. Accounts payable decreased by $5,000. At the beginning of the year, it was $40,000, and it decreased to $35,000. That basically means we owe $5,000 less at the end of the year than we did at the beginning of the year. Okay, then let's go over here to the income statement. I want to go through a couple of things here. Okay, depreciation expense. Okay, what we're working on is the cash flow statement. Depreciation expense is an estimated figure that accountants come up with to estimate what part of the assets has depreciated that year. There's not a guarantee that that is exactly the number. It's just an estimate that we use so we can get as accurate of a number as we can. If we did not do depreciation, then our accounting records would not be accurate. With that being said, since depreciation expense is on the income statement and it is an expense, it is decreasing net income. Net income is sales minus expenses. So if you don't have as many expenses, your net income is going to be larger. If we didn't have any depreciation that we had to do, our net income would be larger. And we are reconciling net income to cash. Therefore, anything that affects net income that is not cash-based, we need to add back in. So that depreciation expense you're going to see when we finish this example is going to be added back in because it is decreasing net income and it is a non-cash item. Therefore, we're taking it out. Okay, this is the operating section of the cash flow statement based on the financial statements provided in the slide before. Now, the first thing we have here, net income is $38,000. So I'm going to go back to this slide. And you can see net income shows $38,000. So we'll start with that $38,000. And then from there, make any adjustments. For the first thing we're going to do is add back in depreciation expense. We are going to add it back in because it is not a cash item, and so we have to take it out to reconcile to cash. Then we have a $6,000 loss on sale of plant assets. We learned in a previous chapter these journal entries. I think it was chapter 10. When you sell a plant asset, you look at its book value, you update all the depreciation, then calculate the book value, and from there you figure out a gain or a loss. That gain or a loss. Okay, another thing I wanted to bring to your attention is, for example, accounts receivable. It increased $20,000, and you see how it's a negative $20,000? Okay, think about the transaction that happens when you use accounts receivable. Okay, so say that you're a store and you are selling an item and they charge it. So you recognize the sale, and that will be a credit to sales, and then you debit accounts receivable. No money has changed hands yet you've recorded your sale. Now, remember, we are taking net income and reconciling it to cash. Well, sales is part of your net income. So when you're reconciling net income to net cash provided by operating activities, you have to back out accounts receivable because no money changed hands and it is increasing your net income by that $20,000. So you have to back that out because it wasn't a cash sale. Okay. Now we're going to look at a couple of the activities that happened that were non-cash. One, okay, again, is the depreciation expense that I already talked about. It decreases net income, but yet it's not a monetary actual cash value, so we add it back in. Loss on sale of plant assets as well as gain on retirement of notes. Both of those are book gain and losses only, not cash. Because the amount I think that we got on the plant assets was $2,000, if I'm not mistaken. Well, so that is the amount that we received from the asset, but yet we have a loss of $6,000 on the sale. And that is because we still were depreciating some of the asset, and we don't know where the asset was in the depreciation process. So that's why there is a loss of $6,000. Same with the gain. Okay, this is a little sheet that you might want to have near you when you're working on your cash flow statement. It will tell you whether you add or you subtract it. Okay, for example, for a current asset, if there is an increase in a current asset, you subtract it from net income. If it is a decrease to from one year to the other is a decrease, then you add it to net income. Because what you're doing is the asset is adding to your net income, and because it's not a cash amount, you need to subtract it back out. Okay, then on our current liabilities, if there's an increase from one year to another, you add it back into net income. That's because liabilities decrease what you owe. And because it's not an actual cash figure yet, you need to add it back to net income. If you have a decrease in liabilities from one reporting period to another, you will subtract that from net income. Okay, so now we're still working with the operating section of the cash flow statement, and this is just the same that was in the slide a couple slides ago. This is just the increase and the decrease of current assets and liabilities. Here's another sheet that you might want to have with you when you're working on your cash flow statement. Okay, let's look at the second two, which is investing and financing. These are much smaller. You want to identify any changes that you had, and then from there you want to look at the T accounts, maybe go into the account and see the activity that happened so you know which section it needs to go under. Okay, I briefly talked to you about the plant assets. Here it went from $210,000 in 2018 to $250,000 in 2019. So that is an increase of $40,000. We also had an increase of accumulated depreciation for $12,000, which I talked about. Okay, so remember that. Okay, let's look at the transactions that happened with this. Okay, they purchased plant assets for $60,000. There was a section in that one slide that said other activities that happened. This is where that information came from right here. We have a company purchased plant assets of $60,000 by issuing a note payable to the seller. So they increased their assets and they they increased their assets, which was a debit to plant assets, and they also increased their liabilities, which was a credit to notes payable. They sold plant assets that cost $20,000. It had accumulated depreciation of $12,000, and they sold it for $2,000. This is where that $6,000 loss comes from. Debit cash, the $2,000 you received, you need to take away or delete that accumulated depreciation account of $12,000. Take the plant asset off of the books, which is the $20,000. The difference is a loss on $6,000. And then the depreciation expense for the year was $24,000. Here are the T accounts for those. So you can clearly see that the plant asset started at $210,000, purchased $60,000, sold $20,000. So the net amount at the end of the year is $250,000. Accumulated depreciation went from $48,000 to $60,000. And then let's look at the financing activities. Let's look at this long-term notes payable. 2018, it was $64,000. 2019, it was $90,000, which means the company increased the amount that they owe by $26,000. Let's look at where that difference is coming from here. Okay, so we have a note with a carrying value of $34,000 are retired for $18,000 cash. So they have a note for $34,000, but it's retired at $18,000, which gives them a $16,000 gain. They owe $34,000, but it's being settled for $16,000. And then cash is $18,000. They also had some common stock transactions. The first one is common stock. They issued common stock. They issued 3,000 shares. This comes from item D in that slide. 3,000 shares at $5 per share. 3,000 shares times $5 per share is $15,000. Their balance was $80,000 in common stock. They issued 15,000, which is a new balance of $95,000. So that means they received cash of $15,000 in that transaction. They also gave dividends to their stockholders, and they gave a cash dividend of $14,000. They started the year off with $88,000. They paid the dividend of $14,000, which decreases retained earnings. And then they recorded the net income for that year of $38,000, which increases net income. The new balance in retained earnings is $112,000. And the only thing that is cash, that affects cash, is the cash paid dividends of $14,000. When looking at the operating activities, we looked at the current assets and liabilities and all of the changes. And we came up with a net cash provided by operating activities of $20,000. So we started with our net income of $38,000. Then we added net cash provided of $20,000, and then that sale of plant assets of $2,000, and then we had 3 activities under finance, which was retiring a note, dividends, and then they issued some stock, which gives you a net cash used by financing activities. They paid cash paid to retire notes, so they paid them. They paid the dividends. Those are both decreases. and then issuing stock was the only increase in financing. So that's a negative $17,000. $20,000 plus 2 is $22,000 minus $17,000 is $5,000. That is the net increase in cash, which does coincide with the financial statements that we looked at a few slides prior. Cash balance at the end of the year is $12,000. Add the two together. That gives you $17,000, which is what it was at the end of the previous year, or what we started the year off with. So we proved cash. Okay, this is the end of chapter 16. If you have any questions, please don't hesitate to give me a call. Thank you.